Welcome to It's the Economy. The rally in the equity market that started in March and continued till mid-June appears to have taken a knock, largely because four central banks last week raised rates, and the FOMC earlier in its dot chart surprisingly indicated that it sees two more rate hikes in the US. Yields have risen in the US from March lows from 3.4 to 3.8. In the currency market, the rupee is caught in India between a stable to soft dollar but a continuously weakening yuan. And the RBI usually doesn't like the rupee to strengthen when the yuan is weakening. A final point, at the moment as we speak, India's call rate, that is the one-day money rate, is at 6.85, way above the repo rate of 6.5. But the Reserve Bank, surprisingly, is not calling for what you call a VRR, that is providing fresh liquidity through a repo. To make sense of where rates and currencies are headed, both globally and in India, I have with me Stephen Englander, the Global Head G10 FX Research in North America, Macro Strategy at Standard Chartered Bank, and Neeraj Gambhir, the Group Executive and Head Treasury, Markets and Wholesale Banking Products at Axis Bank. Gentlemen, thank you very much for joining me. Neeraj, with your permission, I'll start with Steve. He's from the United States and has been staying up for us. Steve, that's really my first question. Equity markets, which were climbing in early June, have started sliding on risk aversion thanks to these four central banks hiking rates and the Fed threatening two more hikes. Do you think this risk aversion that we are seeing will continue for some time?
First, we don't think that they're going to hike as much as they say they're going to. We're not even sure they're going to hike once. It's all very data dependent. But I would agree that the commentary that we're hearing from the central banks suggests almost a common determination that they're going to try and convince the markets that they're going to keep rates higher and keep raising rates, on the view that inflation, certainly in G10 economies, is more stubborn than they had anticipated.
Okay. Well, the hawkish, Fed talk, we'll come to that later. What is your expectation of a possible US recession, Steve? Right now, data is strong, but can there be a cliff-like fall in the economy if the Fed pursues with two more hikes?
I don't think so. And I think that even if we do get to two hikes, the message from the Fed is likely to be that future hikes are more spread out, that it's not going to be 150 basis point hike and then they say they're done, or 225s in a row, but that they're going to hike, pause, see what happens, see if they have to go further. I think it would, for them to be go back to the aggressiveness that they showed last year, you have to see more than have inflation stabilize at these levels. Inflation will have to actually start going back up again. And we don't think that's likely. So to answer your question precisely, we think it's going to be a relatively gentle slowdown. It doesn't mean it's not going to slow down, but it's going to be relatively gentle and no cliff edge with respect to the economy. Okay,
I'll come back to your analysis of the US economy in just a bit. But Neeraj Gambhir, the global yields will have an impact on us. And these four central banks kind of rattled, looks like the Reserve Bank as well. How do you see Indian yields moving? Especially because now it looks like the Reserve Bank moves whenever the call rate goes below the repo rate. But when it goes above the repo rate, they're not acting.
Yeah, so to handle the two questions separately, one is the expectations of the rates. As far as the rates are concerned, I think notwithstanding the recent hawkish commentary from global central banks, I do expect India to stay on a pause mode for an extended period of time. The reason is that our inflation is not as misbehaved as probably it's in the West. Our forecast of inflation for this current year is 4.8% average, which is a shade below 5%. So I think the inflation in India is fairly well managed in that sense. It is slightly above the target of RBI, say about 100 basis points above where RBI would like to see. But I don't think there is a need for us to compress the economy or compress the demand in a major way at this point in time. So I think it'll be a wait and watch, pause mode, whatever you call it, for RBI for at least another 5 to 6 months, till such time the entire story on the Western front, as far as the rates is concerned, plays out. Now, on the liquidity management, I think we are seeing ebbs and flows on liquidity side, depending upon how the government finances play out. At this point in time, the liquidity in system is tight because there was a large amount of outflow that happened on account of advance tax and GST payments. That has basically led to the overnight rates actually inching up. And I think there is some expectation that as the month-end spending by the government happens, probably some of this will normalize, which is why probably we have not seen so far an intervention from RBI to provide short-term liquidity into the markets. I think overall, if you see the liquidity in the system, it is very balanced. It is about 1 lakh crore surplus, and that keeps on moving between the government and the banking system, depending upon what the government spending patterns are. So I think we will continue to see this dynamic on the liquidity management, where Reserve Bank will step in if they see a persistent shortage in the liquidity in the system.
Okay. Yeah, I mean, it's just that they're taking their time to step in when liquidity ebbs away. But Neeraj, just to scratch the point, Steve here is not even expecting one more rate hike. I mean, he was hesitant about it. I'll get back to him on that point. But if there were to be 2 rate hikes from the US Fed and the way in which the BOE is moving, it looks like other central banks are also not done with their rate hikes. Won't interest rate differential be an issue? In that case, can there be stealth tightening by the Reserve Bank through exactly this liquidity measures?
Possible that we might see persistent liquidity tightening in the system if the situation so warrants. And therefore, it means that a 25 basis point implied tightening without a change in the repo rate. But again, I think we have to bear in mind that policy in India is very domestic driven. As I've been mentioning, that inflation is not, runaway inflation in India. It's very well managed. So I don't see a reason for us to be that hawkish. I think the central bank commentary across the world will continue to be hawkish. They need to posture that way, otherwise the financial conditions can tend to become very loose. And that's not what they want. But I think overall, I do feel that we are in a very, very sort of stable interest rate regime now.
Okay. So balanced rather than tightening, as I'm trying to make you say, you expect it to remain more balanced. Okay, let me pursue the risk aversion point with Steve. Steve, the jobs data has been surprising on the upside for 14 consecutive months. Now, Morgan Stanley recently put out a note saying that they expect payroll data can turn negative even as early as September. Now, if that happens, can there be, turmoil in the risk markets like equities?
I wouldn't say it's going to be a turmoil, but, in the same way that the markets were over-enthusiastic about Fed cuts and central bank cuts a few months ago, I think now they've bought into the view that rates are either going up or going to stay at current levels for an extremely long period. I think sentiment will change very quickly if, say, payrolls comes in at 100,000. I think cuts will be, not immediately, but later in the year will be back on the table. So I think what's happened is that the absence of clear signs of slowing has induced a lot of hawkishness. But the question investors should ask themselves is, what if we do see tangible signs that the U.S. economy is slowing down? How long will that kind of rates hawkishness persist? And we think that it would stop very quickly.
Let me toss that, Neeraj. Neeraj, I'm sure you're also looking at the non-farm payrolls numbers and such like. If they were to dip, but if the PCE inflation doesn't dip as much, we don't still have the May numbers, the Fed may be forced to look at that number. So can that dichotomy of a falling payroll number but not falling inflation lead to kind of turmoil towards the third and fourth quarters?
Typically you tend to see the payroll numbers or wage data as the leading indicator of inflation. I think inflation, if the wage growth comes down, if the job growth comes down, there is an expectation that as the incomes actually reduce, the inflation could have a downward bias. So I would say that market would look at wages and wage growth and job numbers as a leading indicator to the inflation. And if we see a consistent, and persistent reduction in those numbers, and we see job losses in US, and we see employment numbers, unemployment data sort of pick up, I think that will give market a reason to sort of start pricing in an end of Fed rate hiking cycle and potentially a rate cut cycle, depending upon how that gathers steam.
Okay, now let me come to the dollar rupee. Steve, how do you see the dollar rupee? Now, even if the dollar index hasn't risen, it's been stable, the yuan has been falling steeply, and Reserve Bank doesn't like the rupee to appreciate when the yuan is falling, when appreciate versus the yuan. So your thoughts on the rupee?
Well, I mean, the rupee is, I believe, the strongest currency over the last month in Asia, or the second strongest, and Chinese yuan is either the weakest or the second weakest. So there has been a divergence there. I think this is a special case because oftentimes when CNY is weakening, it sends a broad message about the world that, something is going wrong. In this case, I think it's more China specific. The delocalization or relocalization, which means movement out of China and from which India is benefiting. I think the economic picture in India is far stronger than what we're seeing now in China. So I think this could go a little bit further. We expect a small appreciation in the rupee, not very large, maybe another 1% or so.
Okay, a small appreciation. Neeraj, your thoughts on the rupee? The latest trade data showed a fairly big spike in imports and a fall in services exports, which was a bit rattling. Your thoughts? Do you think there is still appreciation scope?
Two things. One is that services exports have been the bright spot as far as our balance of payments is concerned. And I think our expectation is that will continue for some time. Second is that even if there is a slowdown in the world economy and as a result of that, our exports slow down, we could also see some slowdown in the imports. So the net impact on the current account remains to be seen. Our base case is that the current account deficit still is going to be below 2% for this year. And overall balance of payments, a marginal surplus of about $15 to $20 billion for this year. So all in all, while there is a balance of payment surplus, I think the need to sort of keep on adding on to the reserves in the face of all the uncertainty that we are seeing, including the geopolitical uncertainty, I think would make sure that we are not anticipating any meaningful appreciation in INR. I think we do expect rupee to be fairly stable around 82. In fact, that's our forecast as an average for the year.
Okay. For all you know, that's why the Reserve Bank didn't do the VRR, the repo. They probably expect they are going to buy dollars, and that will anyway provide liquidity. Very quick last question, and I actually wanted to discuss this well with you, Steve. The new phenomenon in the global economy is the growth of the Japanese economy. I mean, 3% GDP after 30 years of zero growth. What does this mean for, an India investor? Can flows into India lessen because Japan's become attractive and there is always the hope of China's economy recovering? Your thoughts?
I think the growth story in India is beginning to get more attention among investors. And in fact, I think the investor enthusiasm about India is growing. I think, Japan is a little bit more mixed. I agree with you that the data are good, but they're good on the back of a very weak currency. So you'd have to be in a terrible, economic situation for it not to sort of register some GDP improvement. We do expect the JPY to appreciate over time, but the central bank really is unenthusiastic. So I think that on growth, I would go with India over Japan. Exchange rate terms, I don't think we're quite at the turning point yet for Japan. It may take a little while longer.
Okay. Well, we have to discuss that in detail on another day. Thank you very much, Stephen Englander, for staying up for us. Thank you very much, Neeraj Gambhir as well, for a 360-degree perspective of the fixed income and the currency markets. Well, a strong India growth story, and that's showing up in the equity markets at this point in time. Wrap up on Bazaar. Chartbusters up next.